Assalamualaikum and hello everyone. Welcome to my channel. Today we are going to continue talking about consolidation of financial statement, and we're now coming again to the issue of fair value adjustment of non-current asset in subsidiary on the date of acquisition. In this video we are going to focus on how do we do the consolidation adjustment for surplus and deficit arising on the date of acquisition. And the surplus and deficit here is the surplus and deficit relating to non-current depreciable asset of the subsidiary, where the fair value of each surplus or the deficit of the asset was not yet adjusted in the books of subsidiary. I have with me a work example 2, where the coverage of this work example has these 5 items to be covered in. The first one I'm going to cover: how do we treat the surplus on revaluation of depreciable assets on the acquisition date, that of the subsidiary, and the deficit on revaluation as well of the depreciable assets of the subsidiary on acquisition date. This is the initial revaluation for the subsidiary that is accounted by the parent, since the subsidiary has not adjusted for the surplus and deficit. And also adjustment for underprovision and overprovision. Underprovision will arise if there is a surplus on revaluation of the asset under provision of depreciation, and overprovision will arise if there is a deficit on revaluation. So overprovision and underprovision adjustment. At the same time, in this video, I'm going to show you how do we do adjustment for depreciation involving reducing balance method. Let me tell you that in my previous video, my work example 2, I have already discuss a fair value adjustment using straight line method, and today we are going to focus on reducing balance method. The next one is that in this particular example, assets of the subsidiary are shown at carrying value. There are no information on costs and accumulated depreciation being disclosed. This is different from my previous example, which is using the example of hammock and shanty. You can check that. I will put the link at my description. This one will cover assets being shown at carrying value. So if you can see the statement of financial position given here, the summary of the statement for the subsidiary and parent company. Subsidiary here is Scrunchy. This is an individual financial statement or their own financial statement without consolidation yet, and Hairband is the parent. And here you have your assets. The plant is at carrying value, and fixtures are also at carrying value. There are no information on cost of the asset and also the accumulated depreciation. And then you have only one investment here, investment in the ordinary shares of the subsidiary, where in this investment of ordinary shares, you invested in 96,000 of the shares. And that 96,000, if you check your subsidiary's information, yes, you have the subsidiary's asset there to be 120,000, the ordinary shares, which is part of the net asset. So you're going to check what is the percentage by taking 96,000, and if you see here is 120, we assume this is actually ordinary shares of 1 ringgit each at the fair value. And here you have information of the general reserve retained profits on 1st of January year 3, and some information on retained profit for the year. Retained profit for the year means retained profit for the current year, where our current year or the reporting date is 31st of December year 3. So 31st of December year 3 is our reporting date, and the retained profit for the year is for the one in as at 1st of January up till 31st of December year 3. Then you have your current liability. So this is the additional information. You have Hairband acquired the shares of Scrunchy on 1st of January year 3. So if you look at the date of acquisition, which is 1st of January year 3, yeah, this is the date of acquisition. That actually happened at the beginning of the current year. Beginning of the current year, because our reporting date is 31st of December year 3. You acquire at the beginning of the year, and the consolidation will be done after a year. So no information is given here regarding what is the pre-acquisition profit or any balance given in the additional information regarding any reserve available. However, the information is actually given here in the statement of financial position itself. So the information that you have here, which is the one for the subsidiary, the one under subsidiary column, the one as at 1st of January, this is actually the information that is also on the date of acquisition. I put the DOA, date of acquisition. So you are given in the statement itself. So you don't have to go and worry so much, because the information is in the statement. It is just not given in the additional information because the date of acquisition is at the beginning of the year. Okay, that was the first one. So you need to check and understand that this is the net asset that's at the date of acquisition, and this is also the net asset as well. And we are talking about the net asset that relates to the subsidiary, right? So the net asset. Okay, then now you have the information regarding the fair value adjustment. In arriving at the purchase consideration for the shares in Scrunchy Berhad, plan was revalued to at 112,000, meaning that the fair value was 112,000. So this is the information regarding the fair value. I put here FV, fair value. Okay, and the fixtures was also revalued, and the fixtures was revalued at 18,000. So 18,000 was also the fair value. Right. However, you are informed here, no adjustment, however, were made in the books in respect of revaluation. So meaning to say that these fair value adjustments were not being made. And on top of that, there were no purchase or sale of these assets. These assets refers to plan and fixtures during the period. During the period means from the date of acquisition until the reporting date, which is 31st of December year 3. Directors wish to give effect to the revaluation. So directors here, you are talking about directors of the parent company, where they in the consolidation itself, the asset of the subsidiary company must be shown at the fair value. If the subsidiary has not accounted for it at fair value, so it's the parent company that needs to fair value the asset and make sure that the consolidated financial statement or the consolidated statement of financial position reflect that fair value. The next one, number 3, is information on depreciation. Legal group, which is the parent, charges depreciation on plant and fixtures. So the one for plant is in red line there. I have put that color, and the one for fixtures is in purple. So you have 10% depreciation for plant and 5% depreciation for fixtures, and both are using reducing balance method. So reducing balance method for both. So that's why they are both the purple and red there. So that was on carrying value. So carrying value means it is at percentage of cost minus accumulated depreciation. You have to prepare consolidated statement of financial position of Hairband and subsidiary Scrunchy as at 31st of December year 3. So this 31st of December year 3 is the reporting date. So reporting date is at 31st of December, year 3. That is the reporting date. And the reporting date is 31st of December, year 3, which is after a year. Okay. You are asked to show the relevant workings. So what are the relevant workings that you need to show? You are going to show the workings for the goodwill on consolidation, the schedule to form or to calculate the group reserve, and the non-controlling interest, and then only you can prepare your statement of financial position, or the group statement of financial position in particular. Right. Let us look at what do we have. I'm putting step-by-step answer. First thing that you should do is always to draw the timeline. So draw the timeline and identify when is the date of acquisition. So our date of acquisition is actually on 1st of, okay, that was the date of acquisition, which is on 1st of January, year 3. That is the date of acquisition, the date here. Right. Next is that you have to look at when is the reporting date. Reporting date was after a year. So throughout this 1 year period is the post-acquisition period. So let's look at what are the reserves that we have on the date of acquisition. The reserve that you have on the date of acquisition is the reserve on 1st of January, year 3. The one that we have just already given in this question, which is 31,000 and 16,000. Yeah, the one that was even in the statement of financial position, because this is the one as at beginning of the year, which is the date of acquisition. So take that 31,000, and that one will be the pre-acquisition reserve, these two. What is the reserve available at the end of the year? Reserve available at the end of the year, you have to look at what are the reserve given as at the end of the year. As at the end of the year, if you look for general reserve of the subsidiary, yeah, there were no change actually, because it was still 31,000. Yeah, beginning of the year was 31,000, and no information saying that there was an increase or decrease to the general reserve. So we assume it's the same. However, for the retained profit, as at the beginning of the year was 16, but as at the end of the year, right, during the year you have a figure of 18,000. So that is the post-acquisition reserve that was not yet adjusted, 18,000. So therefore, in your preparation of workings here, your retained profit at the end of the year would be 34,000. Why 34? Because post-acquisition period, you have a figure of, during the post-acquisition period, you have a figure, you have an increase of, I put the plus sign there, an increase of 18,000. So that increase of 18,000, if you add up with 16,000, this is the post-acquisition figure, post-acquisition period. So the post-acquisition profit, so therefore it is 34,000, because retained profit at the beginning of the year is 16, retained profit during the year was 18, and therefore the total 34,000 is the retained profit as at the end of the year. Retained profit as at the end of the year. Now, done with that, we can now also calculate what are the percentage acquired. So if you calculate the percentage acquired, it would be 96,000 from 120,000 of the ordinary shares, and that one will give you 80%. Therefore, NCI was 20%. Next one is to work out for the depreciation part. So what you will do is you are going to find out the surplus or deficit. So to find the surplus, right, what you will do is you will compare fair value with the carrying value. So you will compare that fair value on the date of acquisition, 1st of July, with the carrying value. The fair value was given, just now we saw the information, was 12,000. The carrying value given in the statement of financial position here, the one that is given here, is not the one as at 1st of January. Year 3. This one is at the one as at 31st of December. So you need to find out what are the carrying value 1 year earlier. To find the carrying value 1 year earlier, what you can do is you take the carrying value as at this date, which is as at 31st of December year 3, and then you gross it up with 100 over 90. 100 over 90 refers to the 10% depreciation that was charged. So if it's 1 year earlier, the carrying value would be more. So you gross up the carrying value. So the carrying value would be 90,000. So I just put the working here for you. I put here CV, which stands for carrying value. Carrying value 90,000 times 100 over 90. So there you get your 100,000. So that is the carrying value on the acquisition date, which is on 1st of January, 1st of January year 2, not 1st of July, sorry. 1st of January year 2, right? Okay, after you have done that, you get your surplus because the fair value is greater than the carrying value. This is the surplus on revaluation, and that was how much? 12. So you will just do the same journal entry like what I have explained in my previous video. So just recognize the revaluation surplus of the subsidiary on the date of acquisition. Yeah, revaluation surplus of the subsidiary of S on DOA. DOA is date of acquisition. And this is the one of subsidiary. So debit the plant account because it is the plant account. And remember, the plant account that you are debiting here is the plant account at the carrying value, 12,000. And credit the asset revaluation reserve of the subsidiary relating to plant. That refers to the pre-acquisition 12,000. That will be adjusted in the fair value of net asset. The next one is that you are going to do the depreciation adjustment. Depreciation adjustment will be done from the date of acquisition to the date. We are going to look at the depreciation adjustment that need to be done by the parent company because of the difference in depreciation. So here, let us just look at how do we work out when it is the case of reducing balance method. So what you can do is you will take the surplus on revaluation, the surplus, which is 12,000, a simple calculation here, and then multiply by 10%. Just take the 10%, which is the rate, because this is reducing balance method. You cannot do this for straight line method. So 10% times 12,000, and this is just for 1 year. If it's for 2 years, you may have to repeat this twice. So 10%, 12,000, that will give you 1,200. And therefore, that 1,200, you need to go and adjust for the depreciation. It was an under provision. As I mentioned, surplus will have an under provision. You need to go and recognize additional depreciation in the group account. So go and debit the retained profit of the subsidiary, 1,002. You will adjust them in the schedule, and you will not credit accumulated depreciation because there is no accumulated depreciation. What you will do is you are going to credit to the planned account at the carrying value, whose planned account is the subsidiary, 1,200. And don't forget to do the adjustment in your schedule. Because the asset is disclosed at carrying value, we do the adjustment for the plan at carrying value. You repeat the same adjustment here for fixtures. And for your information, I'm doing this because fixtures will have a different issue here, where fixtures will relate to a deficit. Let's see how. So fair value as given in the additional information was 18,000. We are going to find what are the carrying value on the date of acquisition. So to find the carrying value, you will repeat the same process again. Take the carrying value. Which carrying value? The carrying value given here, this 19,000, the one under the fixtures. Okay, that one. Take the one under subsidiary, don't take the one under parent. Take that 19,000 and gross up by 100 over 95. What is 100 over 95? That one is because the depreciation is on 5% reducing balance method. So you gross up 100 over 95 and you will get 20,000. That 20,000 means this is a deficit. So deficit on revaluation arising on the date of acquisition was 2,000. For the deficit in line with MFRS 116, we are doing the accounting treatment here. We debit to the retained profit of the subsidiary, the fixtures, right? And this will be adjusted because this arise on the date of acquisition. That will be included in the calculation of goodwill, and credit fixture at the carrying value 2,000 for the deficit. Next is to adjust for the depreciation. Adjustment for depreciation is slightly easy for reducing balance method because you just need to gross up again. So depreciation adjustment as at the date of acquisition, what you will do is you're going to take the deficit on revaluation, which is the deficit of 2,000 here, this 2,000, deficit of 2,000. Okay, and then you will multiply with 5%. Deficit 2,000, multiply with 5%, and you get 100. This is only adjustment for 1 year. Should you are adjusting for 2 years, you will need to repeat this twice, right? Next, the consolidation adjustment. This is CJE or Consolidation Journal Entry number 4, which is to recognize the reduction or the overprovision of depreciation. So you need to go and reduce your retained profit. How do you reduce? Reduce your depreciation by crediting the retained profit of the subsidiary with 100, debiting the fixtures at the carrying value since there are no accumulated depreciation account by 100. That will be later reflected in the SOFP, and the one that you adjust to the retained profit will be reflected in the SOPL or the retained profit schedule. Now proceed with the calculation of goodwill. So if you have seen the information given, the goodwill, you will start by putting this first, consideration transferred, that is from the SOFP. You can check your SOFP. The consideration transferred was given here, 170. Okay. Next, you need to find out the fair value of the net asset. So the share capital was 120,000. This is the share capital in SOFP. In the subsidiary column, retained profit. Okay, for the retained profit, the pre-acquisition balance was 16, but that need to be reduced with the deficit, because remember we have the pre-acquisition deficit. So reduce that by 2,000. That will give you 14,000. And this deficit is being charged against the pre-acquisition retained profit. $14,000. General reserve, this is general reserve, pre-acquisition general reserve, that is given. And then you have another one, asset revaluation reserve, which relates to the plant that you have had a revaluation surplus. So that also need to be included here, right? Only that retained profit we make adjustment for deficit. Another way of doing it is that you just leave the retained profit as it is, and you create one more row here and put the deficit after the retained profit, but make sure to deduct them. So the total for the fair value of net asset is 177,000. Non-controlling interest will be measured at the proportionate share of the net asset in the subsidiary. So it will be 20% from 177. So you have the goodwill of 28,400. Now we will proceed with our schedule. The first thing is to put the non-controlling interest. The non-controlling interest, the figure here. Put the figure non-controlling interest, the one that you get from the calculation, this figure, put that in your schedule. The second one is to work out what you have done in your working. So the first thing that you need to do is to put the balance. Put the balance, we start off with the subsidiary. Put the balance as per the statement of financial position, the one given in the statement of financial position. For Scrunchy, the subsidiary, and make sure that you have put the correct column. One column for subsidiary retained profit, one column for group retained profit, one column for subsidiaries general reserve, another one for the group, or the group is actually the Hairband. The subsidiary is Scrunchy. Okay, so you put that column, and then start by doing your consolidation journal. Consolidation journal that you have done earlier was the one related to deficit. So the pre-acquisition profit also will have to deduct the deficit here. So that will become 14,000. And now you have the post-acquisition profit balance here to be 20,000, and you will proceed with the adjustment on depreciation that we have done earlier. For the revaluation deficit, you have 2,000 there, right? That you debit to your retained profit or profit or loss and credit to your fixtures account. The next one is for the depreciation that was underprovided, you debit your retained profit and you credit your plant at the carrying value. That was the figure 1,002. Remember to reduce them. For the depreciation overprovided, you need to go and add back the depreciation because it has been overprovided. Add back to the retained profit of the subsidiary. With that, you have the adjusted post-acquisition balance of 6,900 and divide them to the parent and to the subsidiary. Sorry, parent and to the non-controlling interest. How do you get this? This is actually 80% from 16,900. How do you get this? This is actually 20% from 16,900. So you are done with the subsidiary. Now we proceed with the one of the parent company. Hairband is the parent, so I put the balance as per soft P. The balance as per soft P. So let us check what is the balance. So if you see, the balance would be here. Balance that you will add up 80,000, the one at the beginning of the year under the parent, with the one at during the year under the parent as well. So 80 plus 32. 80 plus 32 gives you 112. 112. So 80 plus 32, 112. So that one being included there. For the subsidiary, for the group retained profit, now you are done. It is 125,520 after taking into consideration your share of the post-acquisition profit of the subsidiary. For the general reserve, we are now doing the just last few adjustments. The one as per the statement of financial position was 31. Where do we get 31? In the statement of financial position. And as at the date of acquisition was also the same figure. So there are no post-acquisition balance, and the parent has no share of that reserve of the subsidiary during pre-acquisition period. So does the non-controlling interest. Okay. Therefore, the group general reserve, the parent has 50,000. You can check the parents column here, this 50,000, that 50,000, and that should be put in the workings under the schedule here. Then you are done with the group reserve. You are done with the non-controlling interest. Done. You can proceed with the preparation of statement of financial position. Okay, start with the title. Put the date correctly. I'm starting with the equity. Remember, the one that you show here is just the one of parent, and the reserve that you will show here is the group reserve coming from the one that you have computed in your workings here. So 50,000 there. 125,520 is the group retained profit. Retained profit from here, and the non-controlling interest will also be disclosed under equity, and the non-controlling interest will be the one that you computed earlier, which is 38,780. The next part is to just add up the current liabilities. So 102,400. The current liability comes from 81,400 plus 21. 81,400 plus 21. You can do the workings here. Plus 31. So you have the figure for the current liabilities. Next is the non-current asset. The non-current asset that you will show here will be the non-current asset coming from plant and fixtures. and that would be at the carrying value. So look at the working that I have put here. What you add is the surplus, because surplus is what you credit to the ARR and you debit to the plan. You reduce with the under provision of depreciation, and that is later combined with the one of the holding and the one of the subsidiary. That will give you 244,800. For the fixtures, you are going to deduct the deficit, because deficit is what reduce the carrying amount of the asset. Deficit. The surplus is what increase the carrying amount of the asset. Okay, the overprovision you are going to add, because you have already adjusted the retained profit and you go and debit to your fixtures account. Earlier on, you go and credit to the retained profit. So you have 41, 47, 100. The goodwill was from the working schedule. And for the current asset, you just need to add the total coming from holding and the subsidiary, and you just need to combine them, and that gives you 272,400. That's it. You are done with the preparation of consolidated financial statement. And this session is to show you again the adjustment for fair value adjustment involving surplus and deficit of non-current depreciable asset of the subsidiary. If you have not subscribed to the channel, perhaps you may consider subscribing and share. If you think this video has given you a lot of benefit, share with your friends. I thank you for watching. Thank you for your attention. I'll see you when I will see you. Assalamualaikum warahmatullah, and have a good day.